Welcome to Stony Finance Lab channel.
Hello, everyone. This is our final presentation for our project. We called it Atomic Investment Habits by Arbaz, Ali Khan, Yuting Wei, and Dongfang Yi. First of all, let me give you the outline. So this project has overview, targeted investor groups, investment goal, investment vehicles, investment strategy, analysis of return and risk, mistakes to avoid, and principles for success. And the last part is summary. The overview part. This project provides strategies for high school graduates and college students who are seeking a way to invest for their future with basic knowledge. We recommend them to use apps like Acorns as the mentors to learn the fundamentals about investment. And we will going through common mistakes, principles of success, and also strategies of investment to help them learn and build the habit of investing. Here is our target investment groups. Group 1, we target high school students, graduates who have income and saving from their jobs. And they may also have little knowledge about financing, but they want to invest for their future. And also group 2 is college students who also have income and saving from their jobs or internships. They have a basic understanding of how investment works, and they are seeking for information about build their wealth in future. The investment goal here is investing by regularly saving small amounts of money, saving for retirement, and gross money you already have with consistent saving and investing. For example, you have $500 and earn 5% in interest, then comes to $527.5. When you earn 5% interest on that, you get $553.88. Compound interest and time has spoiled the success of many top investors. With a diversified portfolio, the historical stock market return is around 10% over the long term. We recommend them invest as soon as possible. The earlier you start investing, the more time you have to take advantage of compound interest. And you need to build a habit in investing. The investment vehicles are invest for now. Invest with your spare change. You will owe taxes each year on your investment income as your funds increase in value based on the stock market's performance. You invest for later. You can use traditional IRA, Roth IRA, and SEP IRA for retirement planning. Invest for early. Start investing for your kids. Set up UTMA or UGMA custodial investment accounts for your children. And jumpstart your savings by combining automatic deposits with round-up investment. The more money you put into your account, the more worthwhile the account becomes.
Now let's look into the 5-step investment strategy we have for the two young groups. So step 1, you should get started early. Time is money, and starting early can give you a head start in your investment goals. Second thing is automate. Set up a recurring deposit on your investment platform. Third one is buy the basket. Investing in index funds and mutual funds can give an average of 9 to 10.5% per year. Fourth is the tax write-offs. Look for investment that provide tax benefits. And the fifth one is be consistent and patient. Let your investment be exposed to the power of compounding. So what is the optimal investment? So according to the book by All Your Worth, the 50-20-30 budget rule, the optimal investment consists of investing 20% of your income in savings. Out of those, 50% in risky investments such as stocks, mutual funds, and other financial vehicles, and 5% in low-risk investments such as money market instrument and bank checking accounts. So investment for beginners. An investment strategy for beginners can consist of three types of investments. First is the 401k or other employee retirement plan. These are long-term investments. So you can start with 1% of your earnings and then aim to match 50% of your employer contribution. The second one is the robo-advisor. Many robo-advisors do not require a minimum deposit. Examples, Acorns, Fidelity, and SoFi. Therefore, investing 5% of your income is more than reasonable. Capital market funds. Start diversifying your portfolio in target date mutual funds, index funds, and ETFs with at least 10% of your monthly or weekly income. Analysis of return and risk. Let's look at some metrics that our investments provide for beginners. Looking at ROI on 401k, you can see we have a return of investment of 8.4%, but it's a highly risky investment with a 15.8% standard deviation. Looking at robo-advisors, still a great standard deviation there, but the return of investment is more than reasonable. Now we look at the main money makers with our capital market funds, which have an average of about 12% of ROI with a relatively lower standard deviations than the previous instruments. Now here are the investments over the years and why it is more reasonable to invest in index funds and small companies stock mutual funds. We can see they have a compounded interest of 11.7% to 10.1% annually. Now, for example, if you invest 1,200 in a compounding investment, but you aren't really adding any systematic payments yearly, you can get around a 4,167% return on your 40-year investment. This does not include taxes and inflation into account. However, if you were to invest the same amount consistently over the year, the next slide, you can see that we have a ROI of 48,685%, which can actually make you a millionaire if you were to double the amount to, let's say, and this is just investing $100 per month, provided that you start at the age of 20. So let's look at the common mistakes that beginners make. Not starting early, not being consistent, unrealistic standards, not diversifying, being impatient, being an active investor, being ignorant. Most young people fall into this category and keep making this common mistake. So let's look at some principles for success. So principles for success, any habit consists of being consistent, stay on track, manifest your long-term goals, and diversify your portfolio. Be passive and patient, and always educate yourself.
And here's our last part summary. Investing young gives you an opportunity to grow even more wealth thanks to compound interest and also gain financial literacy skills from a young age. Individuals who start investing as teens rather than waiting until later in life have a huge advantage over their peers, both in their potential returns and the knowledge they can gain from investing. Most people understand that they should be investing, but many may not have considered the benefit of investing for or with their teens. And please be mindful of the common mistakes and focus on building a habit of investing. Here's our presentation. Thank you.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.